Welcome, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's our telephone number. Pick up the phone and give us a call. It is a holiday weekend, and welcome, and thanks, everybody, for listening in. If you are out in the listening area and you are looking around for properties this weekend, look hard, because there are very few out there that are affordable. I've been in a couple of real estate deals myself where we've been going back and forth with the seller in terms of trying to negotiate two different buyers, two different sellers. And you know what the problem is that the sellers think their properties are worth a lot more than they probably are. And we're in a situation right now where we've got interest rates rising. We've seen actual interest rates fall a little bit, but since last Thursday or Wednesday, when the Fed raised the Fed rate another quarter point, where we've probably already priced in the increase through the bond market purchases and sell for the mortgage rates. What I'm trying to say is the mortgage rates are going up. Property values are obviously steady, if not going up. Sellers think their properties are worth way more than I think they're worth. But if you're a buyer out there right now, understand that it is not simple. In both of these cases, in negotiating, they were inflexible with price, even if a property's sitting on the market. Now, sitting on the market, what does that mean in this market? Normally, as I always talk about, the equal buyer to seller is about 5 months. So you're looking at, let's say 5 times 4, 20 weeks. So if you've got an equal number of buyers and an equal number of sellers, a normal property is going to sit on the market for about 20 weeks, 5 months. In this market, you're seeing them probably no more than 30 to 45 days. Well, in one of these properties that I was negotiating, this property had been on the market for 60 days. Now, what's the signal to you? There's either something wrong with the property or there's something wrong with the price. And everybody knows it's price, price, price. I mean, you say it's location, 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 not in a seller's market. It's price, price, price. You as a buyer are out there looking right now for a property that you can afford, not the best place. Because in a down market, you always just look for location, location, because you can grind sellers in a down market, i.e. it's a buyer's market. In this market, you cannot, because they want price. You might be able to get them flexible on certain aspects of the sale. For instance, instead of a 30-day escrow, maybe you can get 45. Instead of a 17-day contingency period where you do your inspections and you get your loan approved, maybe you can get 21. By the way, it used to be 21 default in the CAR contracts. And if you're listening to this show outside of the Los Angeles, outside of the San Bernardino, Riverside area, Ventura County, or up in Tahoe, where this may be also listened to, as well as in Las Vegas, Nevada, maybe your area of the country has a little bit different slant on how these things are done. But we here in California have a very standard CAR, California Association of Realtor contract, where we have built-in dates, built-in deadlines, and most of this stuff doesn't change decade to decade. Used to be 21-day contingency period. They've lowered it to 17. Why? I don't know. Now, you're supposed to get, and if you're out there and you're listening and you're in contract, yes, you're excited, but you have a window, a short window by which you have to do all the things you have to do. So back to the properties that I'm hopefully getting into escrow, even though we're inflexible on price, trying to get a little bit of play on the contingencies, whether it be the inspection period, whether it be, maybe get the seller to pay some closing costs. And by the way, in a down market, seller pays closing costs all the time. In a market like now, not going to happen. Like we used to be able to ask 4 years ago, 3% closing costs on an FHA deal. Now, FHA will allow up to 9% if you didn't know that. But in this particular case, not going to happen. Why? Why should they give up 3% when they don't have to? There's another buyer down the street, probably doesn't need an FHA loan. Probably can get this done easily with a conventional loan with 20% down. That's the way the market is going, especially if you're in a price situation whereby the price is a pretty good price for one buyer, and so they're just going to come in with either all cash or a 20% down normal conventional loan. An FHA buyer is signaling that they don't have the down payment, and those particular buyers are a little bit more at risk from getting properties just because in a seller's market, the seller is looking at the sale and saying, how quick am I to my money? How much risk do I have to take before I can get my money? And how long is it before I get the deposit? And this is another aspect of the negotiation in any real estate deal. If you're dealing with large real estate companies, Coldwell Banker, let's just pick Coldwell Banker, right? They are trained, as a lot of large companies train their real estate agents, that initial deposit, or the earnest money deposit, as it used to be called, that is usually at least 3% of the purchase price. Why? Because most buyers are going to sign that liquidated damages clause. And liquidated damages, as you all know, protects the buyer. No more than 3% default in any situation where there's a buyer default. Now, what is a buyer default? Well, everyone knows. Let's say you get down 2 days before the close, you removed all the loans contingencies, you removed the time period escrow contingencies, you've moved, loan appraisal, inspections, anything that had to do with waiting, time contingencies, they're all removed 2 days before close, and the buyer gets cold feet and doesn't want to buy. That's what we call buyer default. And they are only limited to 3% of the purchase price if, in fact, they have signed liquidated damages. And that's why that particular aspect of the contract, when you're dealing with large companies, they want the 3%. Why? Because it's a simple matter of, if you default, the 3% that they're entitled to is already in escrow. So it's just a matter of negotiating the release of that money to the seller. In certain situations, and in a lot of areas of the country, let alone Southern California, I think that's too much money. And I know the big companies want to make it simple, and I know that sellers certainly like the warm and fuzzy with having 3%. But if you're willing to put at risk the loan and the value of the property for 30 years, let's say, of the term of the loan, and how long you're going to possibly be living at the property, I think the risk to the buyer of not getting the full 3% if liquidated damages is called for on a buyer default, I think it's reasonable to expect or assess that the buyer should not have to come in with that kind of risk. Let's say you're going for VA financing. Now, VA financing is 100%. So if you're saying to the buyer on a VA financed loan that you want a 3% earnest money deposit, well, what's going to happen at the end? You're going to get a refund? Well, everybody knows that there's all kinds of things that can go wrong with that money. Now, it shouldn't go wrong, and it should be very simple. But the least money you have to put up front on a 100% finance loan is to me a better understanding of how it should go in terms of representing your buyer. Now, obviously, the seller's agent's not going to think that. Seller's agent's going to think, well, wait a second, why won't you put up the 3%? You're going to get the money back anyway. And I look at it like this. I'm getting a loan. I'm risking that the property is going to hold value for the highest possible price in a seller's market. That's a lot of risk right there. I don't need to put additional risk. For instance, I'm going to buy the property anyway, or let you know whether I'm going to buy it or not after 17 days, right? You're going to know whether I'm going to buy the property after the 17-day contingent period. So for the 13 days between the 30-day close and the contingency period, that there is this risk if I default, i.e., a risk of whatever the amount is, you shouldn't have to worry all that much, whereby I have 30 years of worry whether that property is going to maintain the value. Now, we all know in Southern California and in many places in the country, property values go up and down like a yo-yo. However, in St. Louis, Missouri, now the reason I know this is because that's where a lot of my family is from, and the property values there really don't go up 3% or down 3%, one way or the other. So what I'm trying to say is most people understand that the risk is on the buyer here, not on the seller. So a bit of education for your agent to tell the seller, you really don't need the 3% earnest money deposit. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks for listening. Be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. That's our telephone number. If you wanted to reach us by email, of course, I'll give you that to you. It's info@malibufunding.net. And of course, we're on YouTube, we're on Facebook, we're on Twitter @Jeff6493. I've got my own new website. It's themortgagevoice.com, and that shows this show as well as our Las Vegas real estate show. We're very excited about it, have a lot of different things that we're trying to do to bring information to buyers and sellers out there in the marketplace, either for a loan or for real estate. It's a difficult time right now to get a house because of the lack of housing and the rising interest rates. However, there is still a number of ways that you can get financing or find a property, and we're trying to bring some guests to the show who can maybe give you a little insight as to how they do it and what they do. Later on in the show, we're going to have Amir Saif on, who's going to talk about probates and how probates work in terms of trying to get a house. Now, granted, you have to go to the courthouse steps and with cash and buy, but there are a lot of people out there who have cash to buy, and he's going to describe the ins and outs of the probate process, and if you obviously need help in doing that, he's available. He's a great guy. And Larry Evans is going to come on and talk to us again about secondary mortgage and how we create funds to loan to the general public to buy housing. It's not as simple. I mean, it's not complex, really. I mean, most of the money is coming from the federal government. I mean, we do not have a 50-50 market, i.e. 50% are government loans either purchased by Freddie or Fannie or Ginnie, or 50% from the private market, either hedge funds, insurance funds, sovereign funds, or large accumulation of REIT capital. No, we're probably 90-10, 10% maybe in private hands and 90% are sold to government. But we may be changing that way. Why? Because the refinance market has really dried up for a lot of people. Every time the rate rises, and it has been rising, we may see 30-year fixed rates up at 5.5%, 6% by the end of the year. Unless we get some catastrophic event, or unless the political winds as they are change, and some event happens whereby there's a change in government somewhere, or there's a change in leadership here, or whatever happens, we are going to see rising rates, and that puts a huge damper on refinances. Refinances were the lifeblood of the economy for probably 5 and 6 years. Why do I say that? Because when the economy was down, the only thing keeping afloat the liquidity in the overall buying and sending is the fact that the interest rates were so low, and as the president said, they were artificially kept low, and I think they were, actually. I think Janet Yellen kept them low. I think Ben Bernanke kept them low, and I think they did so in order to fuel obviously spending by the consumers. As you know, 3/4 to 80% of the GDP is fueled and funneled by spending from the consumer. So if we're not spending money, obviously that's a problem, because nobody's buying products. If nobody's buying products, people get laid off. People get laid off, the unemployment rate goes up, and then we have real problems. So keeping that cash flow going has been the really object of the Fed, and object of a lot of us in the lending business. That's why the rates were so low. But now that they're going up, this is signaling, obviously, the economy is doing better. Jobs are great. If you're right now entering the job market, what you're seeing is a plethora of jobs. I have a son graduating college this year. He is looking at many different job applications, and I don't know if you are like this, or people that you know who are having kids get out of college and they've paid off their mortgage or pretty close to it, as we have at our house. And you're wondering where your child is going to work, because you're thinking long term. You're thinking maybe they want to get married one day, maybe have a kid, buy a house one day. You're thinking, how are we going to help them? If you have a child like mine who's out of college, 4-year degree, expensive college, and says to you, yep, this is what he said, I don't know what I want to do. Oh my gosh, if I hear that one more time, I don't know what I want to do. And Daryl over here is putting his hand to his throat, and that's exactly how you feel. Look, I understand it's confusing, and anybody who's listening to this show is probably older than getting out of college, and probably has children, trying to figure out not only their retirement, but also how they're going to help their kids get their first house, or a condo, or afford their rent. You want to have somebody be able to say to you, you know what, I'm fired up about getting that sales job, or I'm fired up about getting into finance or retail or whatever the career is, because that shows to you that, hey, this money I spend is well worth it. I don't think that's the way it is with millennials. I just think that a lot of them are sitting around going, I don't know what I want to do. I don't think this is good. I want to play video games. I want to mess around on my phone. Yeah, I know. I've got kids. I understand it. But if you're thinking about trying to help them out, you're going to have to set up a plan for them. I wrote my daughter a letter 2 weeks ago, and I in the letter, and she's 18, she's a freshman in college. I said, this is what you're going to be able to do, and this is what I want to teach you now. And it's about money, about how money works, about how money can work for you if you plan accordingly. If you don't, you're going to be stuck like a lot of people are stuck right now. My generation, hey, I'm a baby boomer. I would say that over half the baby boomers out there have zero money saved for retirement. And why do I say that? Because I have a lot of friends who are in their mid-60s. They're still working, scrambling because they just don't have enough money saved up for retirement. And believe me, if I've got problems right now at 63 years old for my retirement, chances are my kids are going to have more problems because Social Security is not going to be the same. There are no company benefits which plan for a 401k or some kind of retirement benefit. The only people paying those kind of benefits are government jobs, and I believe that the contracts that will be signed in the next 10 to 15 years will eliminate a lot of that bump to the unions and bump to workers that work for the government, for the cities, for the state, and for the federal government, because we just can't afford it. So there's a lot of ways that a mortgage, the education to what you need to know about properties here in Southern California, properties in Nevada, properties in certain parts of the country where you've got a terrific advantage whereby it's still cheap enough to be able to afford. If you're buying a $300,000 property in South Carolina, you're going to get a lot of property. If you're buying a $250,000 property in Las Vegas, Nevada, you can still buy a property out there. And rates being below 5% currently, that's a good deal. Now, the one thing that I may say that will help you understand where I'm going, rents are on the rise too. So if you can get a property and you can get somebody in there to rent and either carry the property or give you a small positive cash flow, you are saving for the future. You are planning for your retirement. You are helping your children by showing them or helping them buy this particular property, that the financial future that they are looking for is really well within reach. For my daughter, I wrote the letter. I said, this is how money works. This is what you got to do. $100 a week. This is what you got to do with it. Here's where you got to spend it, what you need to save for, because understanding that enables people to realize that the American dream is not a dream. What it is, it's your ability to be able to make, save, and plan for the future as opposed to waiting for someone else to do it. The opportunity that you have to get out there and do this kind of work, either for your children, for yourself, or for future generations, is in your hands. You don't have to give it away. You don't have to rely on somebody else. No. The way the economy is going right now, nobody's working for jobs for 30 years anymore. It just doesn't happen. So you have to have a very good idea of what happens. Let's say you get the 401k from your current company. In 5 years, can you take that? Can you self-direct? Can you roll it over into something else? I'm not a financial planner, but I do know that based on what we're seeing right now in both the projections for what millennials are going to deal with and the current situation for people in my generation, people have not planned, and we need to pass on the ability to plan to future generations. And one of the ways to do that, of course, is real estate, but there are plenty others. Hey, I'm Jeff Barton. I'm your voice in the mortgage business? Thank you, Terrell. I'm your voice in the mortgage business, and we'll be right back. Thank you.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's our telephone number. Pick up the phone and give us a call. We do talk mortgages. We talk real estate. We talk all things about money, real estate, what you need to do now and in the future in order to take advantage of whatever market we're in. Right now, we're in an ascending real estate market, as everyone knows. Prices going up. The other thing happening, obviously, is that the real estate market is pushed prices to a point whereby if you had low interest rates or lower interest rates, you could get more people into the market. Well, that's not happening either. Interest rates are rising, although they've flattened out and lowered a little bit today. But I think by the end of the year, as I've said in previous shows, and I said again today, we're going to see rates up to 5.5%, possibly 6% by the end of the year. So how does this all affect you? Well, one of the reasons that we have rates and do what we do is because we have money in the marketplace to lend. And part of that has to do with the secondary market, people who buy loans, people who buy loans from somebody and then sell them either to Ginnie, Freddie, Fannie. And in order to explain a little bit about that, back to the show, haven't been in a while. Larry, haven't heard from you in a while, but thanks for coming on the show. Larry Evans from Castle Mortgage. I really appreciate you coming on the show.
Hey, well, thanks for having me, Jeff. I appreciate it when you offer out the ability to get on the show and educate people across the airways, across the nation. I think that's really cool of you. Good thing for Malibu as well.
No, I thank you, because what most people don't understand is they think when they get a loan, it's just with the bank at the corner, and somehow that deposit of their money goes in their account at the bank in some vault every month. That doesn't happen. Can you just explain a little bit about the realities of most mortgages and how they work today?
Well, okay, so Castle Mortgage has been around since 1986. We are one of, I want to say, around 500 banks, and we're considered a non-depository bank.
Right.
Because we don't take money in. All we do is buy closed mortgage loans, or at least that's what we used to do. Now we've offered a different program for that mortgage broker, and you are a banker, correct?
We are a mortgage banker, yes.
Yeah. Okay. So, and you're one of our clients. So
yes, we are.
What happens is you're the borrower. Instead of going to a Wells Fargo or a B of A or Chase Bank, which only has their one product, well, that borrower has the ability to go to you, a mortgage banker, which has availability for a plethora of products. And I just happen to be one of your investors, Castle Mortgage, and we sell direct to Fannie Mae, Freddie Mac, and Ginnie Mae. So when that customer or borrower comes to Malibu to do a loan, you're going to search through, based on their criteria, the best deal for them. And, it could happen to be something, a loan that I have at Castle Mortgage. And so once you close that loan on your own warehouse line, then you approach me or Castle Mortgage, and then we'll turn around and purchase that loan from you. It's got nothing to do with the borrower. Once the borrower closes their loan with you, they're done. The only difference is the borrower will probably get a letter saying, hey, this is where you need to make your payments to now, 30 days after they close the loan. And that would be us.
Now, in the secondary market, a lot has been made over, I guess, the course of the last 8 or 9 years since we had the huge recession that we had as a result of some of the issues that we're dealing with now, or have already dealt with through Dodd-Frank in the mortgage business. They're talking about the problems of trying to unwind or figure out who owns a particular mortgage when that particular mortgage is bought and sold several times, then eventually to Fannie and Freddie, or to the secondary market on the private securitization, and then they're divvied up. How do you delineate who owns what if a mortgage is defaulted in the marketplace? How is that decided? Because I know a lot of people worry about that as a result of what had happened. Will it happen again? And how are we sorting through that at this point?
It's a good question, and unfortunately, I'm on the front end, and that's on the back end. So I'm not extremely versed on that, but I can tell you that what happened with the mortgage implosion back in 2006, 2007, 2008, you know, and then we had, you know, Frank Dodd coming into play. You know, basically what we had happening was the guys on Wall Street developed these exotic mortgage loans.
Yep.
Some of them were called
Option.
What is it? NEGAM.
Yeah, NEGAM option payment.
Option arms.
Yep.
And, you know, I've been in the business since '86. I used to work for Great Western Bank, which had that product. And that was one of our stable products.
Yes, it was.
And the guys on Wall Street, you know, basically said, well, look, we can cut these mortgage-backed securities up into, like, derivatives and sell, you know, parts to people over in Europe and here, wherever. So the only guy that was really making the money was that Wall Street guy.
Right, the seller of them, the guy who packages them and sells them, right.
Right, and a lot of the banks had no idea at the time that, you know, this one loan for $300,000 was carved out 5 times and went to, you know, 5 different entities.
Right.
And that's where, you know, we had the problem with the foreclosures and foreclosures taking too long because nobody knew who actually owned the property or how many people owned the property. And so...
well, how many people owned the note is what it is. I mean, who owns a note when 17 people have purchased into it on a derivative that maybe they have a pool of loans that 1% of their investment is invested in one property where, you know, it's very confusing.
It is, and it was. And I believe now that process flow is gone away with the advent of the Dodd-Frank Act. And, you know, unfortunately, you know, when they were introducing that act, they gave the mortgage broker basically a bad name.
Right. Right.
And it actually wasn't the case. The mortgage broker isn't the bad guy. The mortgage broker's out there trying to help his customer out. And the mortgage broker's got nothing to do with what happens afterwards. Now, the only thing I could say is that the mortgage broker was responsible for explaining to the borrowers how the pick-a-pay loan worked.
Right.
Which, for me, I thought it was a great loan. I mean, you got 4 payment options. And you know, you can pay as your pay is happening. Well, Frank Dodd thought that was a bad loan, and it would put people into more harm. And I kind of agree because, you know, if the borrowers made the interest-only payment every month, then, you know, the principal is never getting paid, or the principal would go down a little bit, but the interest would go back on top of the principal that they only made the interest-only payment on.
No, I agree with that. And
in essence, their balance would go up instead of going down, let's say, over the course of a 30-year period.
Well, the reverse mortgage product is exactly that. That is exactly what you do. You can pay it. You don't have to pay it. You can pay the interest. You can pay a part of the principal. You can pay more than the principal. You can pay principal, interest, taxes, and insurance. So the reverse mortgage, again, is exactly like that. But even that got into trouble where they changed the way reverse mortgages are done. And so there are very few of them being done now because the default rate went up so high at the end of last year.
Correct. And again, that product is a product that Castle does not seek.
You guys don't buy that, right? Okay.
So with that being said, there's a plethora of products that are out there from the GSEs. From Fannie Mae, from Freddie Mac, from Ginnie Mae. Ginnie Mae does your VA loans and your FHA loans, as well as some other exotic loans. But Castle, we basically primarily focus on the bread and butter, which is your 30-year fix, your 20-year fix, your 15-year fix, your 3, 5, and 7-year arms. And I do have to say, though, that Fannie Mae has stepped up its marketplace by adding a new product called Home Ready,
right?
Which kind of mirrors your FHA loan, although FHA has a credit score. Well, all products have a credit score requirement, and FHA's credit score requirement can drop as low as 580.
Right, right.
Well, Fannie Mae
Hey, Larry,
still-
we're up
Yeah.
against a clock here, man. That went by fast. Holy smokes, that was good.
Wow.
I know, right? No, it's interesting when you get into talking to this stuff, and we can, we'll absolutely have to have you back to continue the conversation. But I really appreciate you coming on the show.
All right. Well, hey, thank you for having me, and I look forward to next time.
I do too, and thank you very much. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929 is the telephone number. Pick up the phone, give us a call. We talk all things real estate and mortgages, lots of opportunity, lots of issues, lots of different ways that you can get into the market and also solve some problems that you might have long-term for yourself, your kids, all kinds of reasons that real estate is the absolute best way that you can get ahead long-term in the U.S. 99% of millionaires in the U.S. did it from real estate, whether you're buying and holding, you buy right, sell right, or whether you're just looking at trying to pay off a mortgage in 30 years. Eventually, you'll get there, and then you'll be, as I am, a paid-off mortgage. I don't have a mortgage anymore, so my house is free and clear, which means that becomes either the legacy for my kids or equity that I can use to go out and do other things in the business. Info@malibufunding.net, and I'm also on Twitter at Jeff6493. We're on YouTube. If you go to YouTube, it's Jeff Barton, Real Estate Voice, something like that. And of course, we're on themortgagevoice.com. That's where this show, as well as the Las Vegas Real Estate Show, is being shown right now. And you can certainly go there and see what we're doing. We're bringing to the show, and I'm very happy to have him back on, talking about probate and short sales, is Amir Saif. Amir, how are you?
Great. Thank you for having me, Jeff.
Thank you very much for coming on. I know that when I talked to you the other day, you were actually at the courthouse buying a property. Explain how that works in the probate world.
Okay, so basically we have two types of probate. One type needs a court confirmation that you have to go to the court and get the confirmation from the judge. And another type, you only get the confirmation from the trustee and you don't have to go to the court.
Okay.
If you are supposed to go to the court, you cannot use a loan. You have to be a cash buyer. They usually give you 7 to 10 days to close, so there is no time to even get hard money. You have to have cash in hand.
Right.
But the other type, if you are buying from the trustee and you don't need a court confirmation, you can ask them for 30-day escrow or sometimes 45-day escrow. And if the property is qualified, you can even use FHA in some cases.
Okay, so how often do these come up, and how do you get a hold of them? I know that's your business. You don't want to give away all the secrets, but just give us a taste of a typical process of how you would obtain one.
Well, basically, there are lists of probates that we pay monthly memberships to some companies that they give us the probates. We work with lawyers who are specialized in doing probate. So there are a lot of different ways that we get these listings. But I want to talk to you about short sales as well, if I still have time.
Absolutely. Go ahead.
You know, there are a lot of families who are in trouble and the bank might take their property away. What we do for them is we work with them and we know how to talk to banks. So we make a deal for them. Instead of losing their property to bank and going to foreclosure, we introduce our investors. They come in, they pay off the bank, and they buy the property from the owners too. In this way, they might sell their property a little bit lower than the property value, but at least they're not going to lose the whole house, and they're not going to lose big chunk of their money too. So what we do is we usually give advice to people who are behind on their payments, and the bank is going to take their money. Because, you know, when you go to foreclosure, and let's say your property is worth $600,000, and you only owe $300,000 to the bank is going to sell your property for $300,000.
Right.
They don't care your property is $600,000. They just want to cash their money. And they are adding lawyer's fee, broker's fee, and everything on top. Let's say they start at $300,000 and they sell the house for $400,000. You think you are going to get $100,000, but that's not the case.
Right.
They're going to tell you that we paid this much for lawyers, we paid this much for paperwork, late payment, all kinds of penalty, and you won't get any money. But when they work with us, we make a deal. We do a short sale with bank approval. In this way, sometimes banks even give out some of their interest. Let's say you owe bank $300,000. If we make a deal with the bank, they are willing to go down to $280,000 and just get their money. And in this way, instead of selling for $600,000, you will sell your property for $550,000, and you will still go out with $250,000 instead of nothing.
So the idea here is,
way.
if you go private like you, rather than just being foreclosed upon, the advantage is that you're going to get some money out of this deal as opposed to getting nothing.
Exactly. They will save at least 80% of their value.
Well, that's, obviously, and you get a good deal because there is some still equity left in the property, so that when you own the property, you can either flip it or hold it or rent it or whatever you guys are going to do with it.
Of course, it's a win-win situation for both sides. We come in with the cash, so we take care of the bank, and we make sure that the owner gets back at least 80% of what they have in the property, so both sides would be happy. The bank doesn't have to go to foreclosure, spend money, take time.
Right.
They get their money back faster. We make money, and the property owner saves their asset and equity as well.
You know, in a market that we are in right now, where we have ascending real estate prices, obviously rates are going up, are there that many properties that are still underwater? Because in certain parts of the country, I could say yes. So what's it like in the area that you're doing business?
They are, to be honest, there are a lot of property owners that they don't want to sell their property and they don't have the money to pay the bank. So they keep hoping that they can come up with some money to pay the bank.
Right.
But when they realize that they don't have the money to pay the bank already took the property away from them. So they don't even have the chance to put the property on the market to sell, and it's going to go to auction. And when it goes to auction, as I said, the bank doesn't care about how much the house is worth. They just want to get their money out, and they want to get it out fast.
You know,
so they lose their money.
What you're talking about here is trying to be of a benefit, obviously, to the person who's in trouble. Why do people let themselves get into trouble? And then what's the difficulty that you have in trying to have these people trust you to be able to do what you're saying you're going to do for them?
So basically, we usually tell them, okay, I'm going to give you 5 of my past clients.
Right.
Talk to them. They had the same problem. We came in, we negotiated with the bank. I know that we bought the property from them, but at least they walked away with money,
right,
and they were able to buy a smaller house. There are some cases that people lose their job,
right,
and they don't have any savings. And
right,
they keep looking for a job, and they hope that they will find another job in the next month, 2-3 months. But time goes really fast.
right,
You know,
right.
You realize 6 months have passed and you're already behind in the bank, and the bank is taking your house away from you.
No, I agree. We had a property like that, and I'll talk to you off air about it. A guy was, when we took the listing, he had already been 3 months behind on his payment, and the buyer that came in couldn't close. So now he's 6 months behind and doesn't know exactly what to do. I'm sure he's, freaking out, as the case may be, because anybody who's in that kind of financial pressure makes bad decisions. Wouldn't you say that's true?
Of course. And there are some cases that the house needs a major fixing,
Yep.
and nobody would buy that house, and nobody can get a loan on the house.
Right,
So
right.
Even in that cases, we come in, we try to help the owner, we negotiate with the bank. So I have seen this a lot, not as much as before, because as you said, the prices are going up.
Yep.
But this is something that if people have any problem, they can call me and we can come in, and it's good for both sides.
What's your telephone number, Amir?
My cell phone is 310-993-3255.
Okay, great.
And even for people who want to buy a house, if they like a house in an area, they can tell us. As I said, we buy short sales, we buy probate.
Right.
Because they don't have cash, we can buy the property and they can buy it from us with a reasonable profit.
Okay, very good. Hey, listen, we're up against the clock here. Really appreciate you coming on the show. Great information, and we want to have you back, so stay tuned.
My pleasure. Thank you for having me.
Thanks, Amir, very much. That's Amir Safe from Malibu Funding, and I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's our telephone number. Pick up the phone and give us a call. We can help you decide what you need to do if you want to buy or sell real estate this spring or this summer. We are in a difficult market for buyers. Everybody knows that. Although there are some properties that are sitting. And if you've got difficult sellers out there that will not accept a reasonable offer, let the property sit. You know what I mean? I mean, eventually it'll sell, but maybe feeling the pressure of what buyers are feeling right now is a good thing for some of these sellers. We need to get back to a place where we have more inventory, and maybe rising rates will help us do that. I know that on the show we've talked to a couple people today. Really want to thank Larry Evans for coming on, talking about secondary markets and how the secondary market works specifically. His company buys loans and then sells them off to Fannie, Freddie, and Ginnie. Fannie, Freddie, and Ginnie are the government GSEs that they called that purchase loans. Probably 70, 75, 80% of the loans out there get sold to these entities, and these entities then package them up and sell to the secondary market as well, so that we can liquefy, i.e. get more money to lend out to you. So companies like mine, Malibu Funding, Inc., which is a mortgage banker, mortgage lender, we go to companies to buy our loans, and then they sell them on to the secondary market in order for us to have money on the front end, which is what we try to do, which is deal with borrowers. We deal with people with needs, people that want to buy properties, people that want to flip properties, people that want to buy something, hold on to it, sell it 4 or 5 years later. Real estate is the way to go if you're trying to get ahead and you have some extra money. It's a great way to do that. There are several strategies to be able to do that, and we talk about that a lot on the show. Reason being is that if you want to get ahead, this is the way. This is the way to save for the future of your children if you buy right, and that you need a terrific realtor, and there are many out there. In the San Bernardino Riverside area, I want to say hey to all my terrific real estate agents out there who work with us. I know that between George Gonzalez, who works in that area, as well as Connie Hernandez, and several of our terrific loan officers, Rick Guerra, and I don't know, there's just Lizette Guzman. I want to say hi to her, even though she doesn't work with us anymore. A terrific person as well. You need to find great loan officers who can work with great real estate agents. This is the key to any real estate deal, is finding people you trust, so that when they're telling you something, it's either how to get the best out of the most out of the money that you have in buying the property that you can get into and afford, or somebody that can say, you know what, this is the best loan program from you. And if you trust that person, you have to go with the advice, because I know that when we're trying to do many things in our business, we get a bad rap, like used car salesmen, like many people out there in the financial services industry get bad rap because we're always pointed out to be people who are only looking for profit, only looking out for ourselves. Well, that's certainly not true. I've been in the business over 20 years, and I can tell you, nobody lasts in the business who has that kind of attitude. Amir on the show earlier is talking about how he helps people who are in a foreclosure situation keep the equity in their house rather than give it away to either the bank or somebody else, with a very simple strategy. And as he said, keeping 80% of the equity in your house, even though you've lost the house, is better than keeping no equity in your house when you lose the house. And there are many people, and Daryl might be able to speak to this as well, who get into trouble and basically are at the mercy of the lender.
The further you get down into the rabbit hole, the more confusing it gets.
Right.
And unfortunately, friends and relatives all have various opinions. Oh, as long as the first is satisfied, the second goes away.
Right.
No big deal. Everything will disappear. You'll end up with a fistful of money no matter what happens.
Right.
You need to immediately file bankruptcy. You need to...
Right, everybody's got an answer.
Yeah, the answers are plentiful. And then when you don't act on those answers from friends and family, they think you're an idiot.
Right. See, I told you. Well, no wonder. Oh, good. I'm glad it happened to you.
How come you didn't tell us earlier? Well, first of all, it's embarrassing that you get yourself into one of those
If you're in
positions.
that situation, it is not simple, easy, and it is embarrassing. Let's face it. Nobody wants to be in a position to say, hey, I'm in trouble. I need help. Nobody.
Yeah, my own best thinking got me into this situation,
Right.
and you'd rely on somebody to try to get you out. And obviously, the best advice that I could give anybody at this point is, a professional, a licensed professional that does this for a living every
Right.
day.
There was a guy, and I talked about it a little earlier on the show, and he was in trouble on his house and hadn't paid his mortgage for 3 months. And by the time we got the listing, he was already in arrears 3 months, 2 or 3 months. And he was trying to figure out, what happened after the buyer that was, needed some help. And he's up against it because he's got to sell the house, and he's all verklempt and really angry and, trying to point fingers and blame and everything else. And that is not the time to make a decision.
The other thing is if you have an ethical bone in your body, right? They say, oh, you can stay in the house for another year, 2 years, whatever the case may be. You cannot stay in your house for that period of time without being harassed and harangued every day with letters
Right.
and phone calls and all of that. And if you really don't care about those kind of things, then it's fine. If you do care about those kind of things, they weigh heavy on your mind. You stay up late at night, twiddling and fiddling and going, what do I do next?
Right.
And all these phone calls and letters and complications, and they weigh heavy on your mind. It takes its toll.
It really does. And so I know the people out there who are listening to the show, some of them are in this particular position. You really need to find a professional, somebody to talk to, just to get some advice, just to get some perspective on it. There is no magic bullet. This guy that got into trouble said he was told that he didn't have to pay his mortgage anymore. Don't worry about it. Well, that's the worst advice. If you've got the money, pay the mortgage. I mean, come on. The worst thing that can happen is, hey, you know what? I don't have the money now, but at least you're not in arrears and they're not trying to foreclose on you.
It actually came to a point where the mortgage company, I was far enough behind, said don't make a payment because it's not going to make much difference at this point.
Well, sometimes the mortgage companies don't want you, not the mortgage companies, but the lender, whoever holds the note says don't make the payments because they want the house. There's equity in it.
Yeah, quite a bit.
Okay, so let's get to 4 topics I just want to briefly go over about the industry, about what we do, about we're constantly thinking about this, trying to make it better, trying to make us better, and some of the things. The first thing that I wanted to talk about is ethics, the business ethics, and how professionalism is done in the real estate and mortgage business. You might speak to this too, Harold.
Well, ethics are everything, right? It's the front page of the newspaper test. If you do things in your life, in your professional life or your private life, that you wouldn't want on the front page of the newspaper, you probably shouldn't be doing it.
It's a great thing. I mean, right now with social media, everybody's on the front page all the time. If you're on Facebook or Twitter or, Snapchat or Instagram, any of these many different types of social medias, and there's tons of them beyond just the famous ones and the well-known ones. You do not want to have your face as the example of the guy or the gal who just ripped somebody off or who didn't return a phone call or who just negotiated so poorly that it cost the client X amount of dollars. It's just, you don't want to be that person.
If you have to apply for a job and as a result of that, you have to delete your Facebook profile, you probably have not done something right or well.
Right. So normally, and I think Daryl hit it right on the head, if you're going to do something out there in the business world that you don't want people to know or you don't want it to be on the front page of the paper, don't do it. And really, it covers everything. Now, it's not just embarrassment, but being professional is knowing the job, knowing what to do, and then knowing how to represent clients in a fiduciary fashion. That is is the actual technical definition I would use, but the front page paper one is even better. Okay, morality, your own personal morality based on the industry morality and how that affects you and your decision making.
Extremely important. I mean, even if your morals are different in your personal life than they are in your professional life, more people are affected potentially by you morally doing something wrong or corrupt. I have run companies, and I've run large companies, and I realize that that's the way that the employees feed their families, house their families, educate their children, and I don't take that very lightly at all. And I have made $135,000 payrolls every week, in cash. And, it's a big deal.
The morality of which we bring to our professional life, from our personal life, from our upbringing, from the culture that we're from in Los Angeles, in San Bernardino, in Riverside, Ventura counties, all over Southern California, we're dealing with hundreds and hundreds of different cultures and how it works. But I think the American idea is, hey, let's be fair. Let's do the right thing. And what is the right thing? You be honest to people. You tell them the truth. You don't try to rip them off. This is what it is to be moral here in the U.S.
I go back to pre-18. It was trustworthy, loyal, helpful, friendly, is courteous, kind, obedient, cheerful, thrifty, brave, clean, and reverent. And that's from the Scout Handbook.
Well, then I
adhere
to that. Absolutely.
Covered
Okay.
most of it.
Just quickly, a couple. We talk about leadership, and leadership is obviously getting people to do what they don't want to do. I mean, that's the $2 definition. But leadership means that from a moral and ethical standpoint, that what you're trying to do benefits not just you, but everybody. And most people are going to go along with what benefits everybody.
Read a book called "Pour Your Heart Into It" by Howard Schultz, who was the CEO of Starbucks.
Yep.
He said to cross the finish line alone is a very hollow and empty feeling. You bring as many people across the line with you as you possibly can.
Ran the Great Race of Agora last weekend, and there were 25 of us. And you are so right. We trained together. We all were successful together as we crossed the finish line. Each of us had different levels of pain, different levels of euphoria, but we did it together, and I think that's key. And the last one, of course, is the negotiations that we do with all of these things: leadership, ethics, and morality. You negotiate from a place of trying to benefit the client first. That's the name of the game in real estate and mortgage.
Win-win.
Win-win situation.
You don't go home and rub your hands at the end of the day saying, man, I beat him good.
Yeah, no. In movies, maybe that works, but not in real life. Thanks, Daryl, for jumping in. I really appreciate it.
My pleasure.
And I'm Jeff Barton, and I'm your voice in the mortgage industry. Thanks for listening to the show, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.